Of Rajiv Jain, Senior Portfolio Manager of Vontobel Asset Management, where he helps oversee over $15 billion in assets, and he joins us from Fort Lauderdale, Florida. Rajiv, good to have you on the program once again. I guess, what do you do in these times, especially when there's so much volatility on the markets?
Well, yeah, I think our impression is that the markets in the last couple of months actually haven't really seen much downside. We saw an early sell-off in August. But after that, they've basically been in a kind of a trading range, despite the fact that news continues to get worse in Europe. I mean, if you just look at the spreads, Italian, even the French are really, spreads are really blown out. So things are looking pretty, are looking pretty dicey in Europe.
Yeah, things are pretty dicey in Europe, especially when you have so much resistance from Germany in terms of using the ECB as the lender of last resort, which some say is a solution, if there's going to be a solution to the ongoing European debt crisis. How do you think Europe's going to play out?
Well, I think it's difficult to say, obviously, but all the indications look, are basically pointing in one direction, where because of the monetary union, without necessarily a fiscal union, you really have an issue. So I mean, it clearly is not. It is not a sustainable situation, and we feel that that ultimately ECB would have to resort to some sort of quantitative easing, or basically printing money. Ultimately, I think we haven't seen enough pressure yet, maybe.
You haven't seen enough pressure yet, maybe? I mean, you have Italian yields at 7% or close to 7%. Is it when Italy finally starts asking for a bailout that we might get some motivation and action, even though we've heard reports that the EFSF might not be lending to Italy?
Well, I think our impression is there's way too much focus on EFSF. If you look at the spreads of bonds versus ESFF bonds, which trade, I mean, the spreads have really been widening quite a bit. So that's what I'm saying, that ultimately ESF isn't a solution. I mean, it's basically a special purpose vehicle anyway, because the question is, why isn't France lending directly or Germany lending directly? They're basically doing it through another vehicle which they hope to leverage. So I'm not really sure whether ESF is a real solution either. I mean, I think the real solution is ultimately some sort of fiscal union, and which for Germans aren't really ready for.
Right.
And that's why we feel that things will most likely get a lot worse from here before the politicians react.
Wow, a lot worse from here. So does that mean markets follow suit as well? It's going to get a whole lot worse on the markets as well?
Yeah, I mean, I think if you look at the equity markets, the valuations look all right if you assume the margins are going to stay here, right? And I think that's where we have to also throw in China. Because Germany is obviously is very dependent on exports. So, and all the lead indicators are now pointing south. I mean, in terms of they're pointing that European economies are shrinking, or at least flat. So the real issue is, as the economies now slow down meaningfully from here, equity markets, we feel, are still being too optimistic. If you look at some of the cyclicals, I mean, they look at low multiples, but that's because of margins which are very high. And from our perspective, we actually see more problems in China too. I mean, property prices seem to be, our work suggests that property prices are actually starting to come off in pretty much all major cities in China, including whether it's downtown Shanghai or Beijing or what have you. I mean, those are the early indications. So if that's happening, I mean, commodity prices can really come off pretty precipitously.
Yeah, I just had a bit of I guess, a flash, because it seems like you're saying problems are deep in Europe. The U.S., I guess, might be affected from the European problems, and then China is also having its issues. So what do you do in the markets? Where do you go?
Well, I think the good news is that there is some domestic growth in some of the markets, including China. So what we have been doing, and this almost for 2.5 years, is that we really have no banking exposure anywhere in the Western world. I mean, we don't want to own any banks in U.S. We have no banking exposure for almost 4 years in Europe, in continental Europe. In Asia, we only have banking exposure to a couple of countries. We would not touch whether it's Chinese banks or Taiwanese banks or Korean banks or property stocks for that matter. So we also don't have any commodity exposure. I'm talking about basic materials. because, again, there's a lot of frothiness on the commodity front. So what we like is the domestic consumption stories, which have done well, but we feel still offer quite a bit of value, whether it's in Brazil, India, or some of the multinationals in developed markets in Europe, Nestle's and Coca-Cola's of this world, which actually are selling a pretty attractive valuation on a long-term basis. And they have, extremely strong balance sheets, so they actually are much better positioned to withstand a lot of potential sovereign issues which you may have in Europe, because U.S. is not that much better off in the longer run. It's slightly better off, but it's not really better off. I mean, the fact is we still have 10%, almost 10% fiscal deficit.
Yeah, gotcha. Hey, Rajiv, thanks for sharing your time today. It's a pleasure to speak to you. Have a great weekend. Rajiv Jain,